Introduction: the most important machine. There comes a point in every professional's life when they realize a terrifying truth. Their ability to earn an income is finite. Your career, your business, your freelance work. It is a powerful engine for generating cash, but it is an engine that requires your constant, direct involvement. Your time, your energy, your health, and your expertise are the fuel. If you stop providing the fuel, the engine sputters and dies. This is the fundamental trap of earning. This book is about building a second machine, a different kind of machine, one that is quiet, patient, and runs in the background of your life. It is a machine that, once built and properly maintained, requires almost none of your time or direct effort. Its only job is to take the cash your first machine generates and make it grow, all on its own. This second machine is your investment portfolio, and it is the only path to true, lasting financial freedom. The world of investing is intentionally designed to feel intimidating. It is shrouded in a dense fog of jargon, complex charts, and screaming headlines, all designed by an industry that profits from your confusion. They want you to believe that you need to be a financial genius, a stock-picking prodigy, or a wealthy insider to have a chance. They want you to think it's a high-stakes casino where your life savings can be wiped out in an instant. This is a self-serving lie. Successful, long-term investing is not about picking hot stocks or timing the market. It is not complicated. It is not gambling. It is a simple, repeatable, and almost boringly predictable system. It is about owning a tiny piece of the greatest wealth creation engine in the history of the world, the global economy, and then letting the relentless power of time and compounding do the hard work for you. This book is the blueprint for building that machine. We will not give you stock tips or speculative strategies. We will install a complete, first principles operating system for your financial life. You will learn the simple, unbreakable rules of wealth creation. You will understand how to build a diversified, low-cost portfolio using just a few simple tools. We will give you a step-by-step guide to opening an account and making your first investment. And most importantly, you will learn the behavioral psychology required to ignore the noise, stay the course, and let your machine do its work. This is not a guide to getting rich quick. It is the definitive roadmap to getting rich for sure. Part 1. The Foundation, the Investor's Mindset. Chapter 1. The Wealth Equation. Your money must work harder than you do. There are two ways to build wealth in this world. The first is by trading your time for money. This is your salary, your business income, your freelance rate. It is active income. It is powerful, but it is fundamentally limited by the number of hours you can work and the rate you can charge. The second, and far more powerful way, is to have your money make more money. This is passive income from capital. This is investing. The wealth equation is the simple, mathematical reality that you cannot achieve true financial freedom by relying on your labor alone. To escape the time for money trap, you must reach a point where the money generated by your assets is greater than your living expenses. Therefore, every dollar you earn but do not spend has a critical new job. It must be deployed into the world to work for you, to earn its own income, and to recruit more dollars to join its ranks. A dollar saved in a bank account is a lazy, unemployed worker. A dollar invested is a diligent, productive employee who works for you 24 hours a day, 7 days a week, forever. The super saver is disciplined and responsible. They earn a great income, and they manage to save 20% of it every month. They dutifully transfer this money into a high-yield savings account. They feel secure watching their cash balance grow. What they don't see is that their army of dollars is sitting in the barracks, idle. Worse, due to the corrosive effect of inflation, their army is actually shrinking in purchasing power every single year. The super saver will have to work for the rest of their life. The strategic investor also saves 20% of their income. But instead of letting it sit idle, they have a system for immediately deploying that capital into a low-cost, diversified investment portfolio. Their money is not sitting, it is working. The investor's capital army is actively capturing value and growing its ranks through the miracle of compounding. The investor will one day have the choice to stop working. The pay-yourself-first automated deployment system is the practical, behavioral mechanism for putting the wealth equation to work. First, determine a specific percentage of your pre-tax income that you will dedicate to building wealth. A common target is 15 to 20%. This is your freedom contribution. Second, set up dedicated investment accounts like a workplace 401k or an individual retirement account. Third, and most critically, you must automate the transfer. For a 401k, the money will be deducted from your paycheck before it ever hits your checking account. For an IRA, set up a recurring, automatic transfer from your checking account for the day after your paycheck hits. Finally, commit to increasing your freedom contribution percentage by 1% every single year. Chapter 2. The Market as a Machine, Taming Fear and Greed with a System. To the untrained eye, the stock market looks like a chaotic, terrifying, and unpredictable casino. The daily news reinforces this view, with breathless headlines about soaring markets and devastating crashes. This perception is what keeps most people on the sidelines, paralyzed by fear. The secret to successful investing is to stop seeing the market as a moody, unpredictable beast and to start seeing it for what it is, a powerful but volatile wealth-creating machine. Over the long term, the stock market has an undeniable upward trajectory. It represents the collective growth, innovation, and profit generation of the global economy. It is a machine hardwired to go up over time. However, in the short term, this machine is fueled by human emotion, fear, and greed, which makes its journey a volatile one. Your job as an investor is not to predict the short-term movements of the machine. Your job is to create a personal system that allows you to ride out the volatility and capture the machine's powerful long-term growth. The emotional gambler is a slave to the market's daily mood swings. When the news is good, they are overcome with greed and the fear of missing out. They pile all their money in at the very peak. When the market inevitably corrects, they're consumed by panic. They sell everything at the bottom, locking in their losses. They have perfectly executed the investor's creed: buy high, sell low. This systematic investor understands that volatility is the price of admission for long-term returns. They have a pre-committed, written plan. When the market is soaring, their system tells them to stick to their regular, automated contributions. When the market is crashing and their gut is telling them to sell, their system tells them to do the opposite: stick to the plan and continue buying shares at a discount. They are disciplined because they are not reacting. They are executing their system. The Investor's Policy Statement, or IPS, is a simple, one-page document that serves as your personal constitution for investing. You create this document in a calm, rational state of mind. Its purpose is to be the rational voice of your better self that you must obey when your emotional, panicked self tries to take over. It should state your core philosophy. It should define your goals or your why. It should define your strategy and asset allocation. And most importantly, it should have a section within case of emergency rules that define exactly what you will and will not do during a market crash. Chapter 3. The Finish Line First, Defining Your Financial Freedom Number. Investing without a clear goal is like driving without a destination. You are moving, but you have no way of knowing if you're on the right path or when you have arrived. To build an effective, motivating investment plan, you must begin with the end in mind. You must first define your finish line. For most investors, that finish line has a name: financial independence, or FI. Financial independence is the point at which your annual income from your investments is sufficient to cover your annual living expenses forever. It is the point where work becomes a choice, not a necessity. Your FI number is the total amount of invested capital you need to achieve this state. Calculating this number is the most empowering and clarifying exercise a new investor can perform. It transforms the vague goal of saving for retirement into a concrete, achievable mathematical target. The vague saver knows they should be saving, but they have no idea how much they actually need. Is a $500,000 portfolio enough? Is it $5 million? Because they don't have a target, they have no way to measure their progress or feel a sense of accomplishment. They are flying blind. The FI architect has done the math. They know that their target FI number is $1.5 million. They know that to reach this goal in 20 years, they need to invest a specific amount each month. They have a financial dashboard that tracks their progress toward this single, clear number. This clarity is a superpower. The 4% rule is a simple, powerful framework for calculating your FI number and determining how much you can safely withdraw from your portfolio in retirement. Step 1. Calculate your annual expenses. First, you need to know how much your desired lifestyle costs. Let's say your total annual living expenses are $60,000. Step 2. Calculate your FI number. This is the 25x rule. Your FI number is simply your desired annual expenses multiplied by 25. In our example, $60,000 times 25 equals an FI number of $1,500,000. Step 3. Understand the safe withdrawal rate. The 25x rule is the inverse of the 4% rule. The 4% rule states that you can safely withdraw 4% of your initial portfolio value each year, adjusted for inflation, with a very high probability of your money lasting for at least 30 years. Over the long term, a diversified portfolio has historically returned an average of 7 to 10% per year. By only withdrawing 4%, you're leaving a significant portion of the returns in the portfolio to continue growing, allowing it to replenish itself and keep pace with inflation. Chapter 4. The Unseen Tax. Why inflation makes saving a losing game. There is an invisible force constantly eroding the value of your hard-earned money. It is a silent, relentless tax that punishes savers and rewards investors. This force is inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, the purchasing power of currency is falling. If the inflation rate is 3%, it means that a basket of goods that costs $100 today will cost $103 next year. Understanding inflation is not an academic exercise. It is a fundamental prerequisite for building wealth. Holding your long-term savings in cash or a traditional low-yield savings account is not a safe, conservative strategy. It is a guaranteed losing strategy. You are on a financial treadmill, and the speed of the treadmill, which is inflation, is almost always faster than the rate you can run, which is the interest rate on your savings account. The only way to get ahead is to step off the treadmill and onto an escalator, the investment markets. The cash hoarder feels a deep sense of security from having a large amount of cash in their savings account. They have saved $100,000. The bank pays them a 0.5% interest rate. Meanwhile, the historical average rate of inflation is around 3%. Every year, their interest earnings are wiped out by the loss of purchasing power. Their real return is a negative 2.5%. Without realizing it, their wealth is silently evaporating. The inflation-adjusted investor understands this dynamic. They keep a reasonable amount in an emergency fund, but know that any long-term savings must be invested. They place their $100,000 in a diversified portfolio with a historical average return of 8%. After accounting for 3% inflation, their real return is a positive 5%. Their wealth is not just keeping pace with inflation, it is significantly outpacing it. The real return calculation is a simple formula. It is your primary filter for all long-term savings decisions. The formula is real return equals nominal return minus the rate of inflation. For a savings account, that would be 1% minus 3% for a negative 2% real return. For a stock market index fund, it would be 8% minus 3% for a positive 5% real return. Inflation is your hurdle rate. Any long-term investment must have an expected return that is significantly higher than the rate of inflation. If it doesn't, it is not a growth asset. It is a depreciating asset. Part 2. The System, Building Your Portfolio. Chapter 5. The Investor's Toolkit, Stocks, Bonds, and the Magic of Index Funds. The world of investments can seem infinitely complex. However, for the vast majority of individual investors, the entire universe can be simplified down to two fundamental building blocks: stocks and bonds. Stocks, or equity, are a share of ownership in a public company. When you buy a stock, you become a part owner. Your potential reward is high, but so is your risk. Stocks are the primary engine of long-term growth in a portfolio. Bonds are essentially a loan you make to a government or a corporation. In return, they promise to pay you regular interest payments and then return your original loan amount at a future date. Bonds are generally much less risky than stocks and provide stability and income to a portfolio. The magic happens when you realize you don't have to pick individual stocks or bonds. You can buy them all at once through a revolutionary tool called an index fund. An index fund is a single, low-cost fund that holds a basket of every stock or bond in a particular market index, like the S&P 500. By buying one share of an index fund, you instantly own a tiny piece of hundreds or thousands of companies, achieving instant diversification. The stock picker spends hours every week researching individual companies. They might get lucky and have a few big wins, but they will also have devastating losses. Study after study has shown that the vast majority of active stock pickers fail to beat the average return of the market. They take on massive risk for a statistically probable lower return. The index fund investor spends almost no time on research. They don't try to find a needle in the haystack. They buy the whole haystack. They buy a total stock market index fund, which gives them ownership in every publicly traded company in the country. Their return will precisely match the average return of the market, which is a winning strategy that outperforms most stock pickers. The three-fund portfolio is a simple, elegant, and incredibly powerful model. It provides global diversification using just three low-cost index funds. Fund 1 is a U.S. total stock market index fund. Fund 2 is an international total stock market index fund. And Fund 3 is a U.S. total bond market index fund. With these three simple funds, you can build a sophisticated, globally diversified portfolio suitable for almost any long-term investor. Chapter 6. The Set and Forget Portfolio. A simple blueprint for asset allocation. Once you have your three core building blocks, U.S. stocks, international stocks, and bonds, you must decide how to combine them. This decision, known as your asset allocation, is the single most important factor in determining your portfolio's long-term returns and its level of risk. Asset allocation is simply the percentage of your portfolio that you dedicate to each asset class. Your ideal asset allocation is primarily determined by your time horizon and your risk tolerance. A younger investor with a long time horizon can afford to take on more risk for higher potential returns, meaning a higher allocation to stocks. An older investor nearing retirement needs more stability and will have a higher allocation to bonds. The key is to choose a simple, logical allocation, write it down in your investor policy statement, and then stick with it. The tinkerer is constantly changing their asset allocation based on the news. When tech stocks are hot, they pile into tech. When they hear a recession is coming, they panic and sell their stocks. They're trying to time the market, a proven losing game. The strategic allocator has a pre-committed set and forget allocation. They have chosen a simple 80% stock, 20% bond portfolio. They write this in their IPS. They set up their automatic contributions to buy funds according to this ratio. Then they do nothing. They ignore the daily news. Their discipline is their greatest advantage. The target date and age-based allocation models are two simple and effective methods. A target date fund is the easy button. It is a single, all-in-one fund that automatically manages your asset allocation for you based on your expected retirement year. When you are young, the fund is aggressive. As you get closer to your target date, the fund automatically becomes more conservative. The age-based rule of thumb is the DIY simple mix. A common formula is 110 minus your age equals the percentage you should have in stocks. So if you're 30 years old, you should have 80% in stocks and 20% in bonds. You can then split that 80% stock allocation between your U.S. and international funds. The exact numbers are less important than the act of choosing a specific rules-based strategy and sticking with it. Chapter 7. The Brokerage Blueprint. Opening your account and buying your first share. You have the mindset, the plan, and you have chosen your funds. The final barrier between you and becoming an investor is the purely logistical step of opening an investment account and making your first purchase. This can feel intimidating. In reality, opening a brokerage account today is as simple as opening an online bank account. A brokerage account is simply the container that holds your investments. Overcoming this one-time logistical hurdle is the final step that moves you from a future investor to an actual investor. The analysis paralysis candidate spends weeks researching every brokerage firm. They get bogged down in complex tools they will never use. The small friction of the process is enough to make them put it off for later, which often turns into years, costing them hundreds of thousands of dollars in lost growth. The action-oriented investor knows that the big three low-cost brokerage firms are all excellent. They pick one, set aside 30 minutes, and get it done. The 1-hour investor is a step-by-step checklist to get you from zero to invested. 1. Choose your brokerage. The big three are Vanguard, Fidelity, or Charles Schwab. You cannot go wrong with any of them. Don't overthink it. Pick one. 2. Choose your account type. The goal is to use tax-advantaged accounts first. The Roth IRA is one of the best. You contribute money after you've already paid taxes on it, and all of your future growth and withdrawals in retirement are 100% tax-free. A traditional IRA lets you contribute money before taxes, giving you a tax deduction today, but you pay tax on withdrawals in retirement. A standard brokerage account is the simplest, but you pay capital gains taxes on your growth. 3. Open the account. This takes 15 minutes. Go to the website of your chosen brokerage and click Open an Account. You will need your basic personal information and your bank account details. 4. Fund the account. Initiate a transfer from your linked bank account. Start with a small, comfortable amount like $100. 5. Execute your first trade. Once the money has settled, it's time to buy. Go to the trade screen. Enter the ticker symbol for the fund you want to buy. Enter the dollar amount. The order type should be market order. Click Preview and then Submit. Congratulations! You're now an investor. Chapter 8. The Automatic Investor. A system for consistent, automated contributions. Becoming an investor is a momentous first step. Staying an investor is what builds wealth. The single greatest threat to your long-term success is not a market crash. It is your own inconsistent behavior. Relying on willpower to manually invest money each month is a recipe for failure. The secret to long-term success is to remove your emotions and your manual effort from the equation entirely. An automatic investor is a system where your investment contributions are transferred and invested automatically, like a utility bill. This strategy, known as dollar-cost averaging, is both behaviorally and mathematically powerful. By investing a fixed amount of money on a regular schedule, regardless of what the market is doing, you automatically buy more shares when prices are low and fewer shares when prices are high. This removes the impossible task of timing the market and replaces it with the simple, powerful discipline of time in the market. The market timing dabbler tries to be clever. They keep their cash on the sidelines, waiting for the perfect moment. They are paralyzed by the need to make the perfect decision, and as a result, they make no decision at all. The automatic investor is not trying to be clever. They're trying to be consistent. They have set up a $500 automatic transfer on the 15th of every month. Some months, that money buys shares at a high price. Other months, during a downturn, that same money buys more shares at a discount. They don't care about the daily price. They are buying a system. This set and forget automation is a simple, 3-step process. You will set this up once inside your brokerage account. 1. Set up the automatic transfer. You will automatically pull a fixed amount of money from your checking account into your brokerage account on a regular schedule. Schedule the transfer for the day after your paycheck hits. 2. Set up the automatic investment. You will automatically use the cash that arrives to purchase your chosen funds according to your target asset allocation. 3. Turn off the noise and trust the system. Now that the machine is running, your job is to get out of the way. Delete any stock market news apps from your phone. Commit to checking your portfolio no more than once a month. When you hear panic in the news, remind yourself that your system is working, buying more shares at a discount. Part 3. The Engine, Staying the Course, and Winning the Game. Chapter 9. The Fee Reaper, How to Avoid the Hidden Costs that Devour Your Returns. In the world of investing, you do not get what you pay for. In fact, the opposite is often true. The more you pay in fees, the less you get in returns. Fees are the silent, relentless enemy of compound growth. They are a small, parasitic drag on your portfolio that, over a lifetime of investing, can consume a shocking percentage of your wealth. A seemingly tiny 1% difference in annual fees can translate into hundreds of thousands of dollars in lost returns. Minimizing costs is one of the very few things an investor has direct control over. The advised investor walks into a traditional financial advisor's office. The advisor charges a 1% annual fee. The mutual funds they are put into have an average expense ratio of 0.75%. The total annual drag on their portfolio is 1.75%. This fee hurdle means their investments must earn 1.75% each year just to break even. The low-cost investor has built their portfolio using low-cost index funds with an average expense ratio of 0.05%. They manage the portfolio themselves, so there are no advisor fees. Over 30 years, the low-cost investor's portfolio can be worth hundreds of thousands of dollars more. They win, not by being smarter, but by being cheaper. The fee audit is a simple three-part checklist for identifying and minimizing costs. 1. Scrutinize the expense ratio. This is the annual percentage fee of fund charges. For broad market index funds, your target should be under 0.1%. Anything higher is a red flag. 2. Avoid advisor fees. Many traditional advisors charge an assets under management fee, typically around 1%. On a $1 million portfolio, that's a staggering $10,000 per year. If you need financial advice, seek out a fee-only financial planner who charges a flat hourly rate. 3. Eliminate trading costs. In the modern brokerage world, this is a solved problem. The big three brokerages now offer zero commission trades on most stocks, ETFs, and their own mutual funds. Your trading costs should be effectively zero. Chapter 10. The Iron Mind, a tactical guide to surviving market crashes. Market crashes are not a matter of if, but when. They are a normal, inevitable, and recurring feature of the investment landscape. A steep market decline is the single greatest psychological test you will ever face as an investor. Every instinct in your body will be screaming at you to get out now and sell your investments to stop the pain. Giving in to this impulse is the single most destructive mistake an investor can make. An iron mind is not about being fearless. It is about being prepared. It's about having a pre-committed, rules-based system that you can execute automatically when you are in a state of maximum emotional distress. Surviving a market crash is about having the discipline to do nothing, or better yet, to continue systematically investing according to your plan. The panicked seller has no plan. When the market drops 30%, they are glued to the financial news. The emotional pain becomes unbearable. They sell everything, locking in a massive, permanent loss. The disciplined rebalancer has been preparing for this moment. When a market crashes, the first thing they do is pull out their written investor policy statement and read it. They follow their in case of emergency rules. They do not sell. In fact, their automated investment system continues to buy more shares at lower prices. This is the Crash Survival Kit, a three-part plan for managing your behavior during a downturn. 1. The pre-commitment. This is the work you do before the crash. Your written investor policy statement is your single most important tool. It is the rational voice of your past self, speaking to your panicked future self. 2. The information diet. During a market crash, the financial news media is not your friend. It is your enemy. Turn it off. Do not log in to check your portfolio balance more than once a month. Daily checking only amplifies the pain. 3. The automate and accelerate response. The default action is no action. For 99% of the time, the correct response to a crash is to do absolutely nothing. Let your automated system continue to run. The acceleration tactic is optional and advanced. If you have a stable job and extra cash, a market crash is the single greatest buying opportunity of your lifetime. This is the time to be greedy when others are fearful. Chapter 11. The Rebalancing Ritual, a simple system for maintaining your strategy. Over time, the different assets in your portfolio will grow at different rates. During a bull market, your stocks will likely grow much faster than your bonds. This can cause your carefully chosen asset allocation to drift. Your 80/20 stock/bond portfolio might become a 90/10 portfolio. This means your portfolio is now riskier than you originally intended. Rebalancing is the simple, disciplined act of periodically buying or selling assets to bring your portfolio back to your original target asset allocation. It is a systematic way to enforce the investor's mantra of buy low, sell high. When you rebalance, you are selling a portion of the asset class that has performed well, which is selling high, and using the proceeds to buy more of the asset class that has underperformed, which is buying low. The drifter never rebalances. After a long bull market, their portfolio has drifted to a 95/5 allocation. When the next crash happens, their overly aggressive portfolio takes a much bigger hit than they were prepared for, causing them to panic. The disciplined rebalancer has a simple, calendar-based rebalancing rule. Once a year, on their birthday, they log into their portfolio. They see their 80/20 portfolio has drifted to 88/12. They calmly execute a few trades. They sell 8% of their stock fund and use the money to buy more of their bond fund, bringing their allocation back to their 80/20 target. This is the annual rebalancing checklist. 1. Choose your rebalancing date. Pick a single, memorable date that you will use every year. 2. Determine your tolerance bands. You don't need to rebalance for a tiny drift. A common rule is to only rebalance if any asset class has drifted by more than 5% from its original target. 3. Execute the rebalance. The simplest method, done in a tax advantage account like an IRA, is to sell the overweight asset and buy the underweight asset. The preferred method in a taxable account is to rebalance with new contributions. You temporarily adjust your automatic contributions to flow 100% into your most underweight asset class until your portfolio is back on target. If you're invested in a target date fund, this rebalancing process is done for you automatically. Chapter 12. The Long Game. From building wealth to living off your investments. The entire purpose of the decades-long journey of accumulating wealth is to eventually reach a point where you can begin to decumulate. This is the phase of your life where you transition from being a net saver and investor to living off the income that your investment machine generates. This is the ultimate finish line, true financial freedom. Navigating this transition requires a final, crucial shift in your strategy and mindset. Your focus moves from maximizing growth to preserving capital and generating a reliable, predictable paycheck from your portfolio. This is the retirement paycheck system, a three-part framework for structuring your financial life in the decumulation phase. 1. The asset glide path. As you approach and enter retirement, your asset allocation should become progressively more conservative. You no longer have a long time horizon to recover from a major market crash. Your stock allocation should gradually glide downwards, and your bond allocation should increase. A common allocation for someone in early retirement is a 60% stock, 40% bond portfolio. Target date funds do this automatically. 2. The safe withdrawal strategy. This is the practical application of the 4% rule. In your first year of retirement, you would sell 4% of your total portfolio value. You would transfer this cash to your checking account to live on for the year. In subsequent years, you would adjust that initial dollar amount upwards by the rate of inflation. This strategy is designed to provide a stable, inflation-adjusted income stream. 3. The bucket strategy. To avoid selling stocks during a market downturn, you can create a bucket system. Bucket 1 is cash, holding 1 to 3 years of living expenses. You draw your monthly paycheck from here. Bucket 2 is bonds, holding 3 to 10 years of living expenses. When your cash bucket runs low, you replenish it by selling bonds. Bucket 3 is stocks, which is the rest of your portfolio. This is your long-term growth engine. You should rarely need to sell your stocks, especially during a down market. You allow this bucket to grow and use it to replenish your bond bucket during bull markets. Conclusion: you're the asset manager. The single most pervasive and damaging myth in the world of investing is the belief that there is a right time to start. We tell ourselves we will start when we have more money, when we know more, or when the market is less scary. This is a lie we tell ourselves to justify the comfortable inaction of the present. The brutal, mathematical truth is that the right time to start investing was yesterday. The second best time is right now. The greatest, most powerful asset you have as an investor is not your intellect. It is time. The magic of compound growth is a force of nature, but it needs a long runway to work its wonders. Every day you wait is a day you are robbing from your future self. This book has been a systematic demystification of the investing process. You began by forging the investor's mindset. You calculated your specific financial freedom number. You then moved from mindset to mechanics. You learned the building blocks of stocks, bonds, and low-cost index funds. You designed a set and forget asset allocation and walked through the process of opening an account and buying your first share. You then put the entire system on autopilot. Finally, you learned the long-term skills of the game: minimizing fees, surviving market crashes, and the discipline of rebalancing. The person who started this book may have seen themselves as an earner or a saver. By mastering these systems, you have cultivated a new, more powerful identity. You're the chief asset manager of your own life. An asset manager is not a gambler. They're a steward of capital. They are a strategist who makes calm, rational, data-informed decisions based on a long-term plan. They're a disciplined operator who builds and trusts their systems. You have taken on the most important C-suite role in your life: CEO of your own wealth. Your final command is this: trust the process. Trust the math of compounding. Trust the historical resilience of the market. Trust the plan you made in a calm and rational state of mind. Your success as an investor will not be determined by your brilliance, but by your discipline. The game is long, and the winner is often the person who simply stays in their seat. Now, go and let your army of dollars do its work. Did this roadmap help you? Your journey is just beginning, but your feedback is crucial. If this book provided you with real-world value, the single best way to support this mission is to leave an honest review on Amazon. More by Gardinski. Your roadmap continues. You now understand the fundamentals of investing. The next step is to build the complete financial system that fuels your portfolio. Book recommendations include From Zero to Financially Free and From Zero to Investor, $1 Million Portfolio,